Folks, we are so lucky at One Rental at a Time to have this gentleman back each and every week. He is a fortunator. He is everything housing. And last time we spoke, I proposed a question. We will get into that in a minute. Let's welcome Lance Lambert to the show. How you doing, buddy?
Hey, good to be back on, Michael. Housing, housing, housing. Always a lot going on.
Absolutely. So a couple of 2, 3 weeks ago, we were obviously doing a discussion. I think off air, I proposed an idea about what would potentially Silicon Valley Bank, Signature Bank, Credit Suisse, what would all this quote unquote banking crisis mean to the lending market? And specifically, given our area of expertise, I wanted to focus on residential lending. So I know you've been able to dig into some research, collect some thoughts on that. So what'd you find out?
Yeah, so trying to get it pulled up right now. Hopefully give me a second.
Sure.
And so essentially what I wanted to do is to go out and track down and see what some of these financial firms and their analysts are saying about it. I didn't want to assume too much. When the news broke, there was a lot of assumptions. Oh, this is terrible for housing. Credit tightening is going to credit tightening is going to, or credit lending is going to tighten so much, blah, blah, blah. But, a lot of this is publicly backed. You have Fannie Mae, Freddie Mac. So it's like, okay, maybe let's dig in a little more before we kind of assume what it's going to do for housing and see what some of the analysts are showing. So I am trying to stall as I find this.
Yeah. So while you looked at it, I'll share with you. And again, folks, you can
Yeah,
follow me on
share your
Twitter.
thoughts.
Oh, you got it? Oh, you want to
Yeah,
hear my thoughts?
yes, your thoughts.
So what I put this out on Twitter, I think you responded, or maybe you acknowledged it with a like, was I think what a lot of people don't realize, and I said this after Silicon Valley Bank, is both Fannie and Freddie are under conservatorship, which means they're government owned and they're not for profit institutions. Also, we have a general feeling that home ownership, specifically first time home ownership, is a good thing, which obviously I agree with. So my theory right out of the gate is, without question, regional banks we're gonna feel less lending on commercial. Refis are going to be harder. But I believed, at least at the entry level, first time homebuyer homes, Fannie and Freddie would stand ready. They would do all the things that they could to make it easier. So while the volume may dry up because of no supply, I thought residential may not feel the impact that a lot of people knee jerk reaction was. That's kind of where I came out on this.
Yeah. And so I found the Capital Economics note, and the title is from Capital Economics is Housing Market Insulated from Banking Crisis. And this note's from March 30th, 2023. They write the latest mortgage market data show the banking crisis has so far had a minimal impact on the housing market. While spreads have increased, the gap between the 10-year and 30-year, overall mortgage rates have dropped and applications for home purchases have increased since SVB collapsed. While it is possible that lenders will already have tightened other lending standards and could do so further in the coming months, we see no need to downgrade our house price or home sales forecast at this time. And I think Capital still 8% peak to trough for price, unless they've come back to 5, which was their initial. And so that's Capital Economics. They're saying essentially, there's not enough there to change any of their forecasts based on it. And so here's the Goldman Sachs one. The note is titled, What to Expect from Tight Bank Lending Standards. And so it goes into it, tight bank lending standards, overall manageable for residential real estate. Investors' focus has shifted away from the risk of a systematic crisis towards the expected aftershock on lending conditions. For residential mortgages, we expect this impact will be muted relative to other forms of lending, such as business loans or commercial mortgages. This view reflects 3 main factors. First, mortgage lending is less sensitive to bank balance sheet pressures to other forms of lending. So they're saying that residential is less impacted by a hit to banks' balance sheets relative to commercial lending and business lending. Only 14% of mortgages sit in whole loan form on balance sheets. Conversely, 68% mortgages outstanding are effectively stripped of credit risk and securitized into agency MBS. And the second factor pertains to significant sparse activity for mortgage lenders. I don't know if they're trying to say that, it's already taken a hit. So there's like not too much more that could take a hit there. That's a little confusing for that second point.
Okay.
And then their third point, lastly, lending standards for residential mortgages had already tightened significantly before recent bank failures, as captured by the Senior Loan Officer Opinion Survey.
Yeah, so so that was Goldman, right? That last one is.
Yeah, and here's just a little more.
Okay.
But to be clear, tighter lending standards will weigh on the residential mortgage sector, but the net impact will likely be more modest than for other segments as small business and commercial real estate loans. So they're saying, relative is what they gave us, relative, and then modest. So we kind of understand where that doesn't tell us a lot that we didn't already probably think.
It's kind of right. At the end of the day, lending is getting tighter is a general statement. Residential will be the least impacted, right? Others will be greatly impacted. I also think they acknowledge that Freddie and Fannie stand ready to buy all of the first-time home buyer home loans that, meet their box, right? They're approve eligible, as they call it. And, oh, by the way, since that first report was written, rates have come down more. I think you publish nightly the 30-year mortgage, which last I saw was 6.16 or 6.18, down quite significantly. And I don't know if you saw this. I'm sure you have, but the audience hasn't. 1 year ago, rates were 5.04. So it's not like a year ago rates were 3% anymore. We're kind of chewing up the time here.
Yeah.
Rates a year ago were over 5.
The shock effect, the actual shock is weighing.
Exactly.
Yeah, that's right. Well, June is the first time it hit 6 last year. So yeah, we're getting close to that. Which should be interesting. It's possible in not too long it could be down year over year, possibly.
Exactly.
And so on one hand, maybe there's some tightening there. But on the other hand, the immediate short-term impact is that rates have went down. We were pressing over 7 right when the bank failed. Like that, literally, that was the week where people started talking about a 6% federal funds rate.
Right, I remember. The 6% funds rate was born on Monday and dead on Friday. I remember.
Logan's thing about that was funny. And so the biggest impact that it's had in the short term is that rates have come down. We're at low. We have literally went down a full percentage point since that Thursday and Friday when the banks went down, which is incredible. And so there's that. I think if the only other impact there could be, which is obviously if things deteriorate more and we go into recession, there's impacts there. Sure. Positive and negative, headwinds and tailwinds. But the other thing is we're in an interesting period where the financial conditions are still tight right now, but the economy is still strong. If the economy were to weaken significantly and employment were to roll over, in theory, financial conditions would weaken, right?
Exactly.
Right? Mm-hmm. But there's the possibility that while things are still tight, if regionally some markets rolled over before the national market rolled over, they could get in that in-between period where they have a rolled over economy, employment, and the financial conditions, mortgage rates are still high. So that's kind of already what's happened, like in places like Seattle a little bit, in places like San Francisco a little bit, where
for sure
their employments have been affected while financial conditions are still tight. So I think that in-between period, if some markets were to fall over there, that could be an impact. But the biggest thing is we're at the spring selling season, supply is tight, and financial conditions just loosened a little bit.
Just
So
loosened a little bit. They're down a point.
yeah, we had not really went to 7 very long. I think a
Yeah.
lot of people had probably been locked at lower rates than
It's
that. But
all
yeah,
psychology. Again, we're getting back, like you said just a minute ago, we're going to be back to a period where we're going to talk about a 30-year rate is down year on year very
yeah,
soon.
yeah. Well, in theory, yeah.
In
As long
theory. Well, I mean, mathematically it's going to happen, but it will be interesting to see. And again, I think the mortgage rate shock is done. I think we're trending lower on rates going forward. Um, and the real problem, we'll talk a lot about this in the second video, is the spring selling season, the supply's not coming. It's just not coming. And if you bifurcate the market between below and above the median, it's even worse for the entry level home buyer. So I'm hearing day after day, as I'm sure you are, bidding wars are back, offer review dates are back, escalation clauses are back. Now, this is very, very, very much entry level housing. But if that's where you're buying, it might be rougher today than it was last year, which is saying something.
yeah, it's an interesting market for sure.
Yeah. To me, it's all about supply. I think a lot of folks assume supply would go up. And as you know, it's not been something I've believed for quite some time. And I think this spring selling season, and unfortunately the next, disappoint on the supply side. But again, Lance, you are all things housing. You are in it deep every day, every week, every month. Where can people follow you?
Yeah, they can follow me at News Lambert, or they can Google Lance Lambert Fortune and find my articles there.
Folks, and on the daily financial news, I quote his statistics 3 or 4 days a week. This is the young man that gives me the data. He's the guy to follow on Twitter at News Lambert, so you can get the data first. Thanks, buddy.
Thanks.